Mortgage rates have officially gone crazy. In fact, we just reached over 7% mortgage rates for the first time in over 20 years. Now, these mortgage rates combined with house prices still being historically high has created one of the most unaffordable housing markets we've ever seen. Now, as crazy as that is, we haven't even begun to see the devastating effects this is going to have on house prices. And so in today's video, we're going to be talking all about what is going on with mortgage rates, what the future holds for mortgage rates, and how if you're looking to buy right now or refinance right now, I'm going to give you some tips of how you can actually lower your mortgage rates so you don't have to pay these new 7% rates. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. So mortgage rates officially hit over 7%, specifically 7.08% according to Mortgage News Daily back on Tuesday. And this is the highest mortgage rates we've really seen since 2002. It was just over a year ago in August of 2021 where mortgage rates were sitting at about 2.78%. But it is important to note that the only reason the mortgage rates even got to those levels is they were artificially brought down by the Federal Reserve. You see, when the pandemic took place back in March of 2020, the Federal Reserve decided they needed to prop up the economy since many businesses were having to shut down and many people were probably not going to be buying houses. Now, the way they propped up the economy firstly was lowering interest rates, and I'm not talking about mortgage rates, I'm talking about the federal funds rate, and this really affected the cost of borrowing when it came to car loans, personal loans, credit cards, or even HELOCs. Now, naturally, by making it cheaper and more affordable to borrow money, more people chose to do that, and also naturally people chose to spend money more. And so that helped a lot of companies' revenues and their bottom lines, and so as a result, although we initially saw a massive decline in stocks, eventually we saw stocks soar to all-time record highs because of this massive economic boom taking place. They also started buying up $120 billion a month of treasury bonds and mortgage-backed securities. And so they were building up this balance sheet, and the reason why that's a big deal is that it directly affects mortgage rates. To put it into simple terms, when there's massive demand towards these treasury bonds and mortgage-backed securities, mortgage rates go down. When there's hardly any demand for mortgage-backed securities and treasury bonds, mortgage rates go up. So because nobody was touching these types of bonds during the pandemic, we naturally saw mortgage rates spike rapidly. We saw them go up over 1% in just 1 week. And so the Federal Reserve stepped in and spent well over $1 trillion into buying down these mortgage rates to artificially low levels that we've never seen before. Mortgage rates hit as low as 2.6% in January of 2021, which is the all-time record low, and because of that, we saw house prices boom like we've never seen before as well. Now, one of the Fed's goals during this time was to prop up the housing market, especially given that these times were supposed to be very challenging economically, and their plan worked with what they did, but the problem is it worked a little too well. You see, at certain parts of the year, we saw nationwide house prices appreciate as much as 23% in just one single year, and we saw some of the worst inflation numbers we've seen in over 40 years. So there was a really unhealthy level of growth taking place across all asset classes, especially real estate, but then in addition to that, you have inflation being at the worst levels in over 40 years, which really affects every single American. And so the Federal Reserve decided to make inflation their #1 problem to tackle. So as inflation numbers rose, we saw the Federal Reserve backpedal on their monetary policy and shift gears from quantitative easing, which is when of course they're buying up assets and building up their balance sheet, to quantitative tightening, which is the opposite of that, basically when they begin to offload their balance sheet. Now, they officially started the quantitative tightening in June of 2022, but even prior to that, in March of 2022, they started hiking interest rates again because of these inflation levels. Now, they would obviously do that to slow down the economy, to fight this inflation. That's a way you can battle inflation, by hiking interest rates, because as you hike the cost of borrowing, you make less people want to borrow money, less people want to spend money, and so naturally with less demand coming to goods and services, inflation levels start to come down. Now all of this has contributed to mortgage rates rising again, but particularly recently we saw a massive spike recently over the last month and a half, and a big reason for that is investors are very concerned that as inflation data keeps coming back, it's proving to be an even tougher battle to face than we initially anticipated. It seems that we're still struggling to fight inflation even with all these rate hikes that have gone into effect. We're also seeing that since September, the Federal Reserve started to double the speed that it's offloading its balance sheet. And so what that's done is it's really had an effect on mortgage rates rising so much so fast. So since last August, we've already seen rates multiply about 2.5 times just since then, from 2.78% all the way to where we're at now at about 7.08%. It's actually the fastest year-over-year increase we've seen since 1981, which is having a drastic effect on the housing market. We've already seen house prices decline about 6% from peak levels, and this is really only the beginning of the housing correction. I really believe we're about to enter the second phase as we've seen mortgage rates climb about 2% more in just the last month and a half. And the reality is it's going to get worse from this point on. The Federal Reserve's top priority is inflation. Inflation data came back worse than anticipated, and so they're likely to stay aggressive at the very minimum, probably get more aggressive, and for a longer period of time. We've already raised interest rates a total of 5 times this year for a total of 3%. We're anticipating more rate hikes in November and December, and the thing is every time the Federal Reserve meets, they come back with their projections showing that they expect interest rates to be even higher than it was in the last meeting. Now, as of the latest meeting this September, there's a good portion of the Federal Reserve that expects that we'll see as high as 5% interest rates in 2023, which is about 2% higher than where they're at now. So as far as the future goes, my personal expectations are that mortgage rates are going to continue to rise both this year and next year, as inflation will be a problem for the foreseeable future. The reality is you still have student loan debt forgiveness that hasn't gone into effect officially yet. You still have Biden that's been releasing 1 million barrels a day from the strategic petroleum reserves. That's going to stop at the end of October, so they've been artificially bringing down gas prices, which has been making inflation numbers look better than they actually are. That ends at the end of October, and that's only naturally going to bring gas prices up again. So as long as this inflation continues to be a problem, the Federal Reserve is going to stay aggressive. They're going to fight that inflation. They're going to hike interest rates. They're going to continue offloading their balance sheet until we can finally get inflation down to those 2% levels. So for whatever reason, if you're looking to buy a house right now, or you're looking to refinance a mortgage, although it's not the greatest time to be doing that, what can you do to lower your mortgage rates? Well, one of the best ways to lower your mortgage rates is to buy down your rate. So essentially you're going to pay extra closing costs, or extra points as they call it, in order to bring down your mortgage rate. Now 1 point equals 1% of the loan. So basically if you had a $500,000 mortgage, you would pay 1 point on that, for instance, you'd be paying $5,000. So let's say you were looking at getting a $500,000 mortgage, and you would be able to bring down your interest rate by 1% with the cost of 3 points. Well, 3 points, as we know, is 3% of the loan amount. So that means we'd be looking at $15,000 in order to bring it down from a 7% interest rate to a 6% interest rate. Now you might be surprised to know that it makes a massive difference to your monthly mortgage payment. You see, with a 7% interest rate, you're looking at a $3,327 a month payment. Whereas with a 6% mortgage rate, you're going to be paying about $2,998 a month, which means that you're saving about $329 a month. Now, when you're doing this, it's important to do the math as far as when you'll get your money back, because essentially you're paying $15,000 extra in order to save $329 a month. So how long does it take you to get that $15,000 back is what you want to work out. And my rule of thumb is you definitely want to be under 4 years in terms of getting your money back. Now, the reason I say under 4 years is Freddie Mac actually did some research into this, and they studied between 1994 and 2020, and what they found is that the average homeowner ended up refinancing their mortgage every 3.6 years. So because of that, you really want to try to keep it under 4 years in a payback, because that's going to be about your break even on average. Now, the next thing to point out is that if you're looking to buy a house right now, you need to realize that the housing market has completely shifted over from a seller's market to a buyer's market, and so buyers have the upper hand at this point when it comes to negotiations. months. The reality is that houses are sitting on the market a lot longer now. Earlier in the year, they were sitting about 16.5 days on market on average. Now they're at 29 days. So all this to say is that if you are a buyer in today's housing market, you are the one that has the negotiating power. And so you want to take advantage of this. And on one hand, you can negotiate the price down on a house, but what might actually work out better for you, depending on your situation, is it may be better to go for a closing cost contribution. Now I'll show you what I mean. For instance, let's say we had a $625,000 house. You're going to put 20% down, so essentially you're going to have a $500,000 mortgage. Now let's assume that mortgage rates are currently at 7%, and so if you were able to negotiate $15,000 off of the purchase price, you'd be taking it down from a $625,000 purchase price down to $610,000. You put 20% down, and so your total mortgage amount is $488,000. Now your monthly payment works out at $3,247, which compared to $3,327 at full ask, you're really looking at a savings of $80 a month by negotiating the $15,000 off of the purchase price. Whereas let's say that $15,000, or really 3% of the loan amount, was enough to lower your interest rate by 1%. Well, we've done the math on that already, and we know that we would save $329. So $329 a month or $80 a month, it's a big difference of what you're getting. Now at this point where the buyer has more negotiating power, you may be able to do even better than that. Maybe negotiate more closing cost contribution, and you'll need to check with your lender, but you may be able to lower your interest rate by more than 1%. Now another alternative of what you could do, and you could even potentially combine these strategies together, is you could go for an adjustable rate mortgage. Now the reason why you might consider an adjustable rate mortgage versus a 30-year fixed rate is typically you're going to get a much lower rate with an adjustable rate mortgage. You might be looking at up to an extra 1% discount on your mortgage rates. Try to shoot for like a 10-year adjustable rate mortgage, because that essentially means you're going to have a fixed interest rate for 10 years, and then after that you're going to have a variable rate. So most people end up moving or refinancing with less than 10 years. So if you already know for a fact you're not going to be in that home for 10 years or more, that might be something to consider. Again, this is more of a last resort. I much prefer 30-year fixed rates, but if you're looking for options to get more affordable pricing and you know you're not going to be there long term, this could be another option to consider. So anyways, looking ahead, I do expect that mortgage rates will continue to go up, which in turn will hurt housing affordability, and so we will continue to see house prices decline. So if you're able to hold off on buying a house, now might not be a bad time to hold off, because house prices haven't really had a chance to correct to where mortgage rates are currently at. And realistically, with where things are headed with the economy, I do anticipate mortgage rates will get worse, which means that house prices will decline even further. So with that said, I hope you guys enjoyed today's video, and if you gained some value from it, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts in the comments below if you have any questions, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out-of-State Investor. And if you enjoyed today's video, I'm definitely going to recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.